In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Google slapped with a $5 billion fine from EU antitrust enforcers who've ordered the company to change the way it puts search and browser apps on Android devices. European Union Competition Commissioner Margaret Vestager joins us ahead. Plus, he's known for not holding back. We'll hear from former Microsoft CEO and current LA Clippers owner Steve Ballmer on leadership in both tech and sports. And tech companies in China are thriving thanks to the country's 2025 initiative. But is it all in jeopardy as U.S.-China trade tensions rise? First to our top story, it is a record that Google wishes it had not set. The European Union has fined the company $5 billion over its Android policies. That's the biggest fine ever in an antitrust case. The EU says illegal practices on Android mobile devices push Google services in front of users. Google was also ordered to change the way it puts search and web browser apps on Android smartphones. Joining us now from Brussels, Bloomberg's Caroline Hyde, who caught up with EU Competition Commissioner Margaret Vestager right after this decision was made. So, Caroline, you got the first TV interview post this decision. What were the key takeaways?
Emily, the key takeaways was the force of the way in which she described this. These are very serious illegal behaviours. I mean, you don't hear that often about such a significant company. The size of the fine, of course, is so eye-popping. $5 billion. Sure, it's a drop in the ocean compared to the amount that Google can afford. They've got more than $100 billion in terms of cash and short-term investments. But it is a record-breaking number. And she went into length trying to describe why to vindicate this sort of amount because of the dominance in search, the rewards that gave Google. The fact that they were so dominant, it means that they get a lot more chunk of change in terms of digital advertising revenue. And that's why, because it's been going on since 2011, she could sort of weigh this sort of fine, the $5 billion. And also, I think what's significant is, once again, she's talking tough while there are such strained relationships between the EU and the US.
So, Caroline, talk to us a little bit more about what the real impact will be here on Google. I mean, sounds like a lot of money, but for a company of that size, it's a drop in the bucket.
You're right, but now it's whether they change the business model. They've been given just 90 days to change the way in which they currently tie in the likes of Google search and the Chrome browser into deals with mobile phone makers and telecom operators that they have to potentially have been agreed exclusive in the past. All that has to be unwound within 90 days. Otherwise, they'll be fined even more, up to 5% of average daily revenues for every single day that they don't rectify the situation. But in the same way that with the shopping ruling that happened last year, when, of course, they felt that Google pushed their own search engine for shopping too much and were hampering competition there, they never gave a prescriptive ideal of what Google should go out and now do to change their business model. So I really pressed her on that. And here's what she said.
The obvious minimum is that the contractual restrictions, that they disappear. Because you find a lot of these things in the contract. Can't do this, can't do that. But it is for Google, and it's their sole responsibility to make sure that this infringement comes to an effective end. And that, of course, remains to be seen what choices they make.
So she wants a change of contracts. That was clear. Also, though, I wanted to ask her, well, how do you make sure that this is effective? As I mentioned, with the previous, well, it was the last record fine, 2.4 billion euros, that Google got in terms of the practices of shopping in Google. They, once again, many complain that some of the tactics that they've used, the way in which they've changed their business model, hasn't actually rectified the situation at all. How can she ensure that competition will improve? Take a listen.
I think it's very important to see in the follow-up of the first Google decision that we have taken no decision yet. And that is, of course, for good reasons, because we cannot say that Google is complying with the decision. So that is very much an open question. And we will do the same thing. We will monitor if Google sort of lives up to this decision.
There's your hint. I think she's saying, look, we've been monitoring how Google has responded to the previous fine and the previous desire to change the way in which they promote their own shopping websites over and above other competitors. And at the moment, we can't say whether they comply. I think this is a veiled threat that Google, we might start finding once again on that respect, you have got to be able to comply to this new area of concern of ours, which is the Android operating system.
Google disagrees with this decision and says they will appeal. What exactly does Google need to do now?
Yeah, I think Google's already come out, and they not only do we see a lengthy blog post coming from Sundar Pichai, the CEO of Google, it also really trying to educate or try and put their point of view across in this statement, for example, saying really that today's decision rejects the underlying business model that supports Android, which has created more choice for everyone, not less. We intend to appeal, as you mentioned. Now, this is really Google trying to spell out that the mobile operating system they provide, Android, is free. It's an open source, free operating system. That has allowed mobile phones to increase in numbers, to become far cheaper because the phone makers themselves didn't have to invest an awful lot in making operating systems of their own. They feel they've added to competition. They feel they've benefited the consumer. What if potentially the change to their business model is the operating system can no longer be free if they can't lock in revenues by ensuring that Google Search is the favoured search engine within the phone? So I think this is a key question as to how Google reacts, but clearly they feel that they've done the economy and the industry a favour rather than been a curse.
Google now has 90 days to end their illegal conduct, appeal aside. What's been the reaction there in Brussels, Caroline?
Yeah, it's been one of sort of a slight shrug of shoulders in that, yes, this is an eye-popping fine. Yes, they're going to have to change their business model. But actually, is it, firstly, too little too late? I think some people feel that there's been 2 years in the making since first shone a light on by the EU. They feel perhaps that Google's now got more than 90% in terms of market share for search. Really, can this change matters now? And I think, notably, perhaps, even though the fine is eye-popping, it doesn't always help rectify the competitive landscape. I caught up with one company which was affected by the previous fine, the previous ruling on Google's shopping. And this is the CEO, Richard Staples, of Kelku. And he's saying, look, maybe we need to go even further in terms of the way Google has to change.
We want to see a competitive marketplace. At the moment, Google doesn't seem to be able to do that, and the construct it's in. A lot of us say, look, maybe the only way to do that is to break them up. We're not the only ones saying this. You've got, the Boston Globe said this the other 2 months ago, and you had the chief economist to the Competition Authority saying it only the other week, that this is the only way to enforce Google properly to fix these markets.
Now, I put that to Margaret Vestager, the Competition Commissioner, as to whether or not Google should be broken up. Is that the really only way you can do it? She thinks that that would push the discussion into the long weeds. It would take too long to make the market competitive. And I think overall, she feels that these companies do benefit the consumer in terms of they make good quality products. They just need to apply by the letter of the law in her mind's eye. Interesting to see how the US reacts and indeed whether US regulators start looking quite so closely, Emily.
That is the question. Caroline Hyde in Brussels for us. Great interview with Vestager. Thank you so much. We're going to talk about this much more later in the show with one of the lawyers who brought the original complaint in this particular case. Now, sticking with Google, the company will be folding its Nest unit into the Google Home Devices division. In doing so, Google has removed Marwan Fawaz as CEO. Google acquired Nest for $3.2 billion in 2014. According to reports, the change came after complaints were received by employees about Fawaz's leadership. Coming up, eliminating late-stage startup challenges. We're going to speak to angel investor Eli Gill, who has some concrete tips on how companies can cut problems off at the start. That is next, and if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Now, Google isn't the only company at odds with the European Union. Airbnb is also facing a regulatory crackdown from Brussels. The online home rental platform has until the end of August to make its pricing more clear. for users. It also has to clarify whether someone is a private or professional host. And Airbnb is facing off with New York City authorities as well. It is helping finance a lawsuit from a host who's accusing city officials of retaliating against him for speaking out in support of home rentals. Our next guest, Eli Gill, is an angel investor who served as an advisor to Airbnb as well as a slew of other companies. He was also a vice president at Twitter and helped launch Google Maps. He has just written a new book called The High Growth Handbook that aims to help startups avoid late-stage challenges like those we just described. Eli, thank you so much for joining us.
Thanks for having me.
So how could Airbnb have prevented some of these regulatory and legal issues at the start, when this is a company that actually, in order to grow in the early days, kind of circumvented the law?
Yeah, so I don't know much about the specific case in terms of what's going on with Airbnb right now. I think in general, as companies grow and scale, they run into regulatory issues over time, in part because they're entering new markets where they may be less familiar, or in part because as they start to get heft, then other companies in the same industry as them start to react. And so in some cases, there may be a lobby or other thing that exists for a company that may go against it once they start to get market share.
So how could they have avoided it? I mean, is there a way that companies can be better prepared for regulatory issues, especially as we see like scooter companies exploding across the country and running into the same kind of hurdles?
Sure, absolutely. I think there's 2 or 3 things they can do. Number one is bringing on a regulatory or compliance person early. So Coinbase, for example, actually had, I believe, their general counsel in their first 10 hires. And the reason they did that is because Bitcoin and cryptocurrencies were a new thing, and they wanted to have somebody on board early who was very thoughtful about the regulatory environment and the compliance that they needed to deal with. And so I think just thinking about that early is important.
So you've been an entrepreneur, an operator, an investor, now an author. And in this sort of startup book space, you've got Peter Thiel, 0 to 1, Ben Horowitz, The Hard Thing About Hard Things, Eric Ries, The Lean Startup. I'm sure you're familiar with all of these.
Absolutely.
What makes the High Growth Handbook different?
Yeah, I think a lot of those books focus on the early stages of the startup. So you're just getting up and running, and how do you find product market fit? In my book, what I'm really focused on is the later stages. So as your startup starts to work and you're going from 100 people to 1,000 people over a year or two, how do you start dealing with executive hiring, with internationalization, with M&A, with late stage financing? So there's a lot of new issues that you face as a founder later, and so this book is focused on those types of issues.
You talk about the rise of mega funds and how firms like Sequoia and SoftBank suck up a lot of the oxygen. How is the fact that there is so much money out there right now changing the competitive landscape for better and for worse?
Yeah, I think SoftBank is unique in that it's 12 times larger than Sequoia's newly announced fund, so it really isn't a class of its own. I think there's 3 ramifications to it in terms of this late stage capital. Number one is there's a lot of preemptive rounds happening. In other words, venture capitalists are funding things much earlier than they normally would, and they're writing much bigger checks than they normally would. So that's one big change. Second is the rise of secondaries. So SoftBank, for example, famously bought out close to, I think it was $12 billion in total of Uber stock. That was a great example of liquidity happening much earlier than an IPO or other things, or a way to circumvent an IPO and sort of push it out for a bit.
So is this good or bad for companies? I mean, sure, if you get to buy sell your Uber secondaries and you're an early employee, you're a happy camper. But is there a concern that the employees will lose their motivation and enthusiasm?
Yeah, I think it's both good and bad. I think that the downsides of it is probably half of the unicorns that exist today shouldn't be valued at what they're at. In other words, they're overvalued. And so I do think.
Is Airbnb one of those? Is Uber one of those?
I don't believe so, but there's a great saying from Warren Buffett that in the short run, the markets are a voting machine, and in the long run, they're a weighing machine. And none of these companies have been weighed by the public markets. None of them have gone public, so it's really hard to tell how they'll be valued until they're out.
So what's your advice to companies when they are trying to set a valuation and they all want to push it when it comes to the valuation about how it could come back to bite them?
Yeah, I think if you get overcapitalized or your valuation is too high, it actually makes exiting really hard. And so you see a number of companies that have had difficulty actually going public, or they had to wait many years to do so until their valuation caught up with their fundamentals. And so the path to liquidity can actually get worse if you overcapitalize the company at too high of a valuation.
Are there any specific examples of this that you would call out, like Dropbox?
Yeah, I mean,
Pinterest?
I think Spotify sort of famously went public through the mechanism that it did to avoid some of the covenants that it had with its own earlier investors. So I do think that there are different companies that have had to adapt to this.
But was that good or bad for Spotify employees and investors?
So far, it seems like it's been good. I mean, the stock is actually trading at a good spot. It seems like employees have not actually turned over much of the stock or sold very much. So it seems like it's overall worked for them.
So I want to talk to you a little bit about Twitter, because you spent so much time there, and it's always in the news. Right now, they're fighting fake accounts, harassing accounts, hostile accounts, and they say they're cracking down on like 10 million accounts per day, and this is very much top of mind with the midterms coming up and the meddling that happened in the 2016 presidential election. I mean, do you think this is something that Twitter can ever get under control?
Yeah, I think it's one of those problems that is an ongoing arms race where the more technology you come up with, there's going to be technology on the other side that keeps adapting. That said, I think Twitter's done a really nice job of starting to clean up some of the accounts that it has. And in general, I've been impressed by the velocity of new features that they've been adding. So for example, they added the capability to thread tweets together in a tweet storm quite recently. And they've done a few other things that I think have been nice and innovative.
So what about Facebook? Do you think that Facebook will recover from this recent data scandal? I mean, we hear anecdotally people who don't use Facebook anymore, or they're angry at Facebook, and yet Facebook executives tell us it's not really putting a dent in advertising or engagement.
I think ultimately Facebook has built a franchise that will survive this storm. I think it's sent an important message to the entire technology industry in terms of how you should again be thinking early about some of the broader societal issues that you're going to impinge upon through your company. And so I think it's been a good lesson for everybody to watch. So
I went straight to the page in your book about diversity and building diverse teams. What is the biggest mistake that companies are making right now that's holding them back from being able to really change the makeup of their workforce? Yeah, in the book, we actually talk with Joelle Emerson, who's from Paradigm, and she has a really great view in terms of how do you increase the diversity of a company. I think fundamentally you want to ensure that you have diversity at all levels. So that includes at the board. So for example, Color Genomics, which is a company I co-founded, our first external board member was Sue Wagner, who's a co-founder of BlackRock. We actually included about a dozen female angels in our very first round of financing. So I think starting early and being very thoughtful about how you have it permeate every aspect of what you're doing as a company, and it's not just about who you hire, it's actually how do you think about it holistically is really important to do. All right, Eli Gill, investor, entrepreneur, operator, and now author of the High Growth Handbook. Thank you so much. Thanks for having me. By. Coming up, former Microsoft CEO Steve Ballmer sits down with David Rubenstein to talk about Microsoft's complicated relationships with Facebook, Amazon, and more. That's next. This is Bloomberg.
Developers.
Steve Ballmer became a viral sensation after taking over Microsoft in 2000 and leading high-energy, arm-waving motivational speeches like this until stepping down in 2014. He oversaw the computer company after Bill Gates' retirement and during a particularly difficult time. Ballmer's reign followed the first dot-com crash and saw the beginnings of Google and the rise of Apple's iPhone. Today, Ballmer remains Microsoft's largest shareholder, owns the LA Clippers, and, according to Bloomberg's billionaire list, has a net worth of $40 billion. Ballmer joined the David Rubenstein Show peer-to-peer conversations to talk Gates, Amazon, and missing out on Facebook.
So, in the year 2000, you become the CEO. Bill decides to sort of retire, became the chief software architect, but no longer CEO. Correct. So, you now can run the place. Were you surprised that Bill decided to retire?
I was surprised. Bill had asked me to be president in 1998, and I'd said fine, and that was another number 2 position, and I was fine with that. And then Bill came to me and said, hey, will you be CEO? And I asked him, do you really want me to be CEO, or do you really kind of want me to be a figurehead? Just tell me. He says, no, I really want you to be CEO. And I would say, was I CEO? Well, because Bill, stayed working every day till about 2008, and I would say I didn't feel like a total CEO probably until Bill wasn't working there every day in 2008, because there was a lot of shared responsibility.
Talk about some of the things that happened while you were CEO.
Yeah, we were saying, what's the path for software, if you will, into the living room? And the only path that was really clear at the time was the video gaming systems. There was no way to be in the video game business and not build the hardware. We had been in the hardware business in a small way. We'd had our mouse product, a few other products along the way. And frankly, I think we probably in many ways should have done more hardware sooner.
Well, you made another investment at a time that was actually criticized. It was an investment in a company called Facebook. I think you invested about $300 million or so. And why did you do that? And did you regret not trying to buy the whole company?
I did try to buy the whole thing. Zuckerberg came up to Seattle. We met down there. I put a concrete financial offer on the table. But it's a little, Ross Perot tried to buy Microsoft from Bill Gates in like '79, and Bill said no. Founders really have a lot of love and passion around their stuff, and even though Facebook was tiny, I think it was 2009, and I offered, I don't know, $20+ billion, something like that, and Mark had absolutely no interest.
Wow, okay. So a couple other businesses, they think the smartphone business that Apple is now more or less perfected, at least in the United States. You were skeptical that that would be a great business. Do you think Microsoft could have gotten into that business earlier?
Yes, we could have and should have. We should have done, in my opinion, we should have gotten in the hardware business, and that's I blew that.
One of the other things that happened during this period of time when you were the CEO was cloud computing. Your own neighbor, Amazon, built this big business under your own nose. Were you surprised that they had become so big in cloud?
They've had more success than I anticipated. I didn't sell them short, but they have had more success. Here's why I'm not saying I was completely dubious. It is very hard sometimes for big companies to do something very different. I call it doing a second trick. At the time, I would call Amazon a one-trick pony. It was doing this retail stuff. It was doing an awesome job. But to do a second trick, you don't get a lot of companies who do that. That doesn't mean Microsoft's out of the game. We started this thing called Azure and Office 365, and my successor, Satya, has taken the thing to very much new heights.
And right before you left, you tried to buy, and you did ultimately, after you left, I think they completed the Nokia acquisition. And that was an effort to get into smartphones that didn't work out. Why do you think it didn't work out?
I think there were probably two reasons. Number one, maybe it was late. And number two, after I left, while the company went ahead and bought it, I don't think there was the same level of enthusiasm at the board level and management level for scaling up and investing there.
Okay. So you ultimately decided to leave, and your successor is Satya Nadella. Were you surprised when he was selected?
No, he was the recommendation that I made. He was the recommendation that Bill Gates made. I thought he was a candidate to replace me, which is why we moved him into his last job, which was running one of the big divisions. And I was glad he got the job because he's done a great job.
Steve Ballmer there, former CEO of Microsoft, now owner of the LA Clippers, with David Rubenstein. To watch the full interview, The David Rubenstein Show, peer-to-peer conversations. Catch it Wednesday, 9 p.m. Eastern. Up next, opening up the Android market. What does the EU decision against Google mean for its competitors, smartphone makers, and the Android platform? And Bloomberg Tech is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok, on Twitter. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Google's $5 billion antitrust fine has caught the headlines, but what does the EU's action against the company actually mean for the Android platform and smartphone makers that deploy it? Joining us now to discuss, Thomas Vigna, Global Head of Competition Law at Clifford Chance. He is lead counsel for Fair Search, the industry group that brought the very original complaint against Google to the EU. He was also counsel for the EU's antitrust case against Microsoft, which concluded in 2009 and required Microsoft to change its business practices. Will this latest decision result to a similar result? Also joining us in London, Bloomberg Opinion's Alex Webb, who argues in his latest column that Google has escaped Microsoft levels of antitrust pain. Alex, how so?
Well, as of course Mr. Vigna will know very well, Microsoft had to, as a consequence of the agreement that it reached with the Commission, offer users a choice. Whenever they were installing Windows on their computer, they had to decide whether their default browser would be Internet Explorer or, for instance, Mozilla's Firefox, and perhaps latterly even Chrome itself. Now, Google, because it doesn't actually own the interface with the user. You know, as much Android is made by Google, but then it's adapted by the likes of Samsung. It's not being forced itself to provide that sort of option. It still will be the case that the handset provider will itself decide which is the default browser.
So, Thomas, you know, given that you brought the original complaint, are you pleased with this result?
Yes, we're pleased. We think this will open up competition in the mobile landscape. It's true, it could have gone further, but the Microsoft decision was one that was agreed to by Microsoft, as your colleague has correctly pointed out. But this is a good decision.
So, Alex, the money is one thing. The new regulations are another. You know, for Google, is the money really a big deal, or is it really you know, the other things that Google now has to comply with?
No, I mean, the money really is a drop in the ocean. It's about $5 billion. Google has cash reserves of $103 billion at the moment. So, you know, it doesn't take a big chunk out of that. The bigger question clearly is then in these remedies that it's going to have to respond to, you know, find a sort of fix, as it were. It will potentially reduce its access to data if people do start using alternative search engines, browsers, and that data, of course, is essential to Google's ads business and allowing it to serve the kind of ads which match user interests and user browsing behavior.
A lot of Google's competitors, Thomas, are happy about this ruling. One longtime Google rival, of course, is Oracle, which is also one of your clients. In the past, Oracle has signed on to letters supporting EU actions against Google and briefed European regulators on Google policies. How much has Oracle been behind sowing this antitrust backlash?
Oracle has most certainly been involved. It's a very serious company and has resources to pursue these sorts of things, but it's been far from alone. There are quite a number of other companies, both large and small, that have been deeply involved.
What is the bone that Oracle in particular has to pick with Google?
Well, Oracle, I believe, is concerned about Google's data-related practices and the conduct that the European Commission has condemned today has enabled Google to commandeer a great majority of the data relating to individuals' use of their Android mobile phones. And Oracle is involved in that area, finds competition has been excluded, and would like things to be opened up there.
Alex, Mozilla, a smaller browser, is one of the companies that is happy about this result. You know, talk to us about how this now, you know, Google is appealing, we should say, but this now could open up room for some of these smaller competitors.
So yeah, as much as Google is it said it's going to appeal, that doesn't necessarily mean that it will put a stop to the 90-day deadline they have to be in accordance with the law, with European law. So you know, there is a slight possibility that a court will, you know, delay that 90-day deadline, but it seems very, very slim, and there's not much precedent for that happening in the past. After that point, Google will have to start paying fines if it doesn't meet the standards that have been set. Crucially, though, you know, this isn't really going to affect anyone's phone that they have in their hand right now. It's really about new phone sales and the agreements they have behind the scenes with those phone makers. Now, the agreement behind the scenes with the phone makers might make it easier for them to pre-install other applications on their phones, but given that they're all set up right now to have Google already, that probably means that phones will be sold still hold all of the Google apps that they have right now. So you won't probably see it from a consumer perspective until the next generation of phone comes out later this year or early next.
Thomas, you know, other companies, including, you know, Oracle, Expedia, Microsoft, these are all Google competitors that have been behind some of these complaints to the EU. You know, how much of this is about competitors getting back at Google, and how much of this is about the EU and the Competition Commission really seeing a problem?
Well, anyone can bring complaints to the Commission, but it's up to the Commission to decide whether to pursue them. And the Commission most certainly would not pursue any case against anyone, including Google, unless it found that there was genuine consumer harm. So quite clearly, that is what happened here, as happens in every such case.
Do you see more actions coming? I mean, the European Commission has taken quite a hard line on especially U.S. tech companies that we don't see from regulators in the United States.
I would not be surprised to see more. There's one more Google case in the pipeline, and conceivably there could be more Google cases coming down the road. I think it is important to note that although the Commission has acted against American technology companies, it generally has a more robust antitrust enforcement policy with respect to dominant companies. And in areas where European companies dominate, such as energy, financial services in Europe, the Commission had.
Alex, what are some other big potential cases on the horizon?
I think realistically, actually, well, of course, we've heard about Google's AdSense case, which is forthcoming. I think more interesting, actually, outside of Europe, will be the extent to which perhaps regulators in India, for instance, or other geographies follow the lead of what's happened here at the Commission level. Google, of course, as any number of other tech companies, is looking for its next billion users, and those are users in India and sub-Saharan Africa. And if these sort of patterns emerge there, Google already has a dominant position in Europe. It's quite hard to displace it. With that, race still happening in these other regions, in getting in quite early, that could create a real problem for them. So that's the sort of regulation that I'm particularly keen to follow.
All right, Alex Webb, Bloomberg Opinion. Thank you so much. And also thanks to Clifford Chance, Global Head of Competition Law, Thomas Binya, joining us from Hawaii. Well, the NSA and Cyber Command are working together to thwart any potential Russian meddling in the upcoming U.S. midterm elections. The move comes amidst President Trump's now admission that he accepts intelligence reports on Russian interference in the 2016 elections. This according to the Washington Post. The joint NSA and Cyber Command efforts may also take offensive actions such as disrupting an adversary's computer networks. Congress is also seeking a measure to allow the president to authorize Cyber Command to disrupt any Russian election interference and social media manipulation operations outside the United States. Coming up, ZTE is back to work, but it's missing a key component, workers. We discuss the latest roadblock for the beleaguered telecom maker and how the deal it cut with the United States could impact Chinese tech firms more broadly. And later, startup Zoox is on the verge of transforming the entire transportation industry by creating self-driving robot taxis. We go behind the scenes. This is Bloomberg. Elon Musk took to Twitter again, this time for an apology. After calling British diver Vern Unsworth a pedophile during the Thai soccer team rescue, Musk wrote, quote, "My words were spoken in anger after Mr. Unsworth said several untruths and suggested I engage in a sexual act with the mini-sub. Nonetheless, his actions against me do not justify my actions against him, and for that I apologize to Mr. Unsworth and to the companies I represent as leader." This apology follows increasing calls from investors and employees for Musk to focus on Tesla's work and take a break from Twitter. China's Geo Harbor Group, a major player in the country's One Belt, One Road initiative, as well as its China 2025 strategy, has been a big beneficiary of Beijing's infrastructure spending boom. The company is involved in $50 billion worth of land reclamation projects across Southeast Asia and possesses what it says is world-leading technology in the reclamation market. Speaking from Shanghai, CEO Xu Shilong explains to Bloomberg's Tom McKenzie how his company will take advantage of China's ambitious plans to fund rapid growth.
I think the Chinese market has passed its peak in terms of building infrastructure projects. In comparison, places like Southeast Asia and the Middle East are now seeing really strong demand, while countries like Vietnam, Indonesia, and Bangladesh have only just begun nationwide construction of highways, power plants, and ports. We see the biggest business opportunities in places like Hong Kong and Singapore, which have large populations but very limited space. They are desperate for land. At the moment, we have over 500 large projects on the go across the world, with a total value of $15 billion. We are very excited about the prospects of our business.
We know that Singapore is in the process of a significant land reclamation project. Are you involved in that? How significant is that as an opportunity for your company?
Singapore has already completed several land reclamation projects. We're now working with the government on new experimental projects where we'll extract mud from under the sea and harden it for reclamation using our own technology. This experiment has been underway for a year, and if it proves successful, we're confident we'll win the full contract. In April, we signed an MOU with the Philippines on a huge land reclamation project that will use mud from a lagoon in Manila to create some 500,000 square kilometers of new land. This will provide living space for roughly 200,000 low-income citizens.
How would you characterize the financing environment now? Are you partnering with development banks? Are you partnering with private investors on some of these projects?
The Philippine government will not provide direct funding for this project, but they will give us ownership of a portion of the land created. In turn, we hope to use that asset to generate revenue for our business. The AIIB has shown strong support by issuing a loan of $300 million to this project. We've also secured investment from Chinese companies like CSG Holdings.
What percentage of your revenues do you expect to derive from projects linked to the Belt and Road Initiative?
Our company began our international push a few years back, and now 80% of our revenue is generated in countries along the Belt and Road Initiative. Our growth in China has plateaued, but we aim to grow 30 to 50% a year in international markets.
What is the time frame for taking the company public?
It will take us another 1 or 2 years to complete our IPO process. The most important thing will be mobilizing capital resources and using our technology to develop land and reclaim land from the sea.
Made in China 2025, this industrial policy that the government here has drawn up, to what extent is that a catalyst for a company like yours?
We plan to set up regional head offices in different parts of the world. So far, we have already done so in Singapore, Dubai, and Panama. In China, we have built an R&D center where we're actively training engineers, technicians, and other talent so that we can expand into more countries step by step.
That was Xu Shilong, Geo Harbor Group founder and chair. For more on what is really going on with the Made in China 2020 plans and how the ongoing trade standoff between the U.S. and China could derail the initiative or hold it back, we're joined in New York by Peter Elstrom, who heads up Bloomberg Tech's coverage in Asia. So, obviously many of the companies, Peter, as a result of this initiative in China are thriving. But how is this trade standoff at this point impacting them?
Well, at this point, they certainly need to be aware of the potential problems with the trade tensions with the U.S. And there are, in terms of tariffs, it will cause certain things to get more expensive. I think the real challenge for some of the Chinese technology companies is if they're not able to get the components that they need from the U.S., the supplies that they need from the U.S. And we saw this with ZTE in particular, where they were not able to get semiconductors from the U.S. and some optical component parts. So they're aware of that. But in the meantime, the 2025 initiative is moving forward, and the cities, which are really responsible for implementing this, are moving very aggressively. We recently went to Nanjing to look up close at their efforts to foster some of these key technology areas. They focused on artificial intelligence and semiconductors, among others, and they're very, very aggressive. The party chief there talked about the financial incentives they give. It goes beyond just free rent and tax holidays. They'll also pay companies for setting up R&D centers. If you're a venture capital firm, they will give you money to come there, and in some cases, they will actually compensate you if you lose money on your venture capital investments in Nanjing. So it's quite a bargain. It certainly is adding some energy to that. There are questions about whether that's going to be that effective in terms of building a competitive technology sector, but they're trying very hard.
The U.S. has meantime lifted the ban on ZTE, but do you think the fear factor from the United States and among U.S. lawmakers is only going to get worse when it comes to Chinese tech companies?
It's certainly an issue, and it's worth looking more closely at ZTE's business. Our reporters recently found that ZTE is struggling to get all of its employees back into the factories to restart operations because they're out in the countryside. ZTE is known for not paying the highest wages in the industry, and they're kind of reluctant to come back in case there are other problems, in case things don't start as smoothly as they had in the the past. And then on the other side, for customers, it's another big challenge. Telecom systems are not like smartphones that you buy once and you don't have to worry about them for a while. They're years-long projects, and if you decide that you're going to hire ZTE to build your telecom network, you want to make sure that they have access to the best technology, whether it's from the U.S. or elsewhere, for a long period of time. So there is a risk if, for example, U.S. Congress decides they're going to impose more penalties on ZTE, there's a risk they're not going to get the equipment that they actually need.
All right. Bloomberg's Peter Elstrom for us in New York. Peter, as always, thanks for breaking it down. Coming up next, your robot ride is here. Sort of. We'll take a ride in the radical Zoox robot taxi next. This is Bloomberg. Blue Origin completed the 9th flight of its New Shepard rocket on Wednesday. The company, owned by Amazon CEO Jeff Bezos, is working toward flying humans to space for the first time as soon as later this year. The booster and spacecraft blasted off from the company's launch site in Texas shortly after 11 a.m. Eastern and then performed a test designed to ferry passengers to safety in case of an emergency. In the crowded self-driving space, Zoox is standing out by building an autonomous vehicle from the ground up. In the latest episode of Hello World, Bloomberg's Ashley Vance meets co-founders Tim Kentley-Clay and Jesse Levinson, who plan to make their robotic cars the go-to rideshares of the future.
We all make poor life choices. Take these two guys, for example. They're the founders of a self-driving car company called Zoox. And they've decided it makes sense to try and compete against this.
Waymo, the Google self-driving car project, Cruise Automation, Daimler, Baidu, Uber, and Lyft.
But Zoox is different. Its rivals are adding self-driving technology to existing cars. Meanwhile, Zoox is making a new type of vehicle for the self-driving age. Basically, Zoox is making a robot, and its early incarnation looks like the love child of the Matrix, Mad Max, and Transformers franchises. This is Tim Kentley-Clay. He hails from Australia, and down under, he was a well-known designer and ad guy. One day he had an epiphany, a vision of the future full of robotic vehicles, and came here to build them.
I sort of just saw the future of how the whole system could work. I said, okay, I need to find a brilliant computer scientist. And so that led me on a journey for 6 months, actually, when I ended up finding Jesse.
That brilliant computer scientist is Dr. Jesse Levinson, a Stanford grad who was sought after by none other than Google itself.
I actually visited Google X in 2013 to come and speak on my vision for autonomy. In talking, a fellow said there's this one guy and he's really good and we can't get him. So that was my signal to go and get him.
A lot of your colleagues have run off to companies like Google or Uber to retrofit their cars. What drew you to this particular task and this approach?
I've been working on self-driving cars since 2005, and it's pretty clear even back then that it was going to be one of the more transformative technologies for society. It wasn't enough to just solve a technology. You need a product and you need a business that makes sense. And I hadn't seen that in any other company until I met Tim, and he shared his high-level vision for what Zoox could be.
And that vision is a system of completely autonomous robotic vehicles that can be summoned just like a Lyft, or, dare I say it, an Uber.
We have a very clear vision at Zoox, which is that AI and mobility will take us out of the age of the automobile and into the next mobility age, which for us is robotics, autonomous transportation.
Grab a little bit to the right.
Tim and Jesse take me to the Alameda Naval Air Station, where I'm about to get a test drive and see how a Zoox robot handles.
These are very unique vehicles. They're designed in a way that would only make sense if they're going to be fully autonomous. The powertrains are designed for full autonomy. They're fully redundant. They have dual high voltage batteries. They have dual low voltage architectures. You can see they're rigged with compute sensors. They can drive without any human intervention. This is VH4. This is VH5. Do you want to go for a ride?
Yeah, I do.
All right, jump in.
Zoox has placed cones on the tarmac. The robot is going to drive out and try to dodge them. And I get to do the whole test sitting backwards, because Tim thought it would be funny.
Keyboard holder. Time to meet my robot maker.
And with one swift keystroke, I give complete control of my life over to an AI.
That really doesn't get old, man. It's like being on a ride at Disney.
These AI robots crank through the course at 45 miles per hour, and the VH5 is set to rip through it at a delightful 75 miles per hour.
We can choose all-wheel steering, two-wheel steering, crab steering, dual motors, and then we have direction.
I like the crab steering.
Is it madness to take on many of the world's leading automotive and tech companies at the same time? Yes, of course it is. But I say go forth, Tim and Jesse. We all await our Lux robotic rideshare of the future.
That was Bloomberg's Ashley Vance. You can watch more of Hello World on Bloomberg.com. And that does it for this edition of Bloomberg Technology. On tomorrow's show, we will be speaking to Hui Ling, the co-founder of Grab, how the Asian ride-hailing giant fought off Uber and raised billions with investors like SoftBank and Toyota. That's all for now. This is Bloomberg.